everybody, it's David Campbell from HassleFreeCashflowInvesting.com. I'm here with my good friend from uDirectIRA.com, Kaaren Hall.
Hey, how are you?
I'm doing great, and I'm so happy that we took the time to make this training video because we get a lot of frequently asked questions about investing in mortgage notes using an IRA. And that's what today's call is about, is how to help people use their retirement funds and either avoid paying interest altogether in the sense of a Roth IRA, or to defer the payment of income taxes in the case of a traditional IRA, and to get the money out of the hands of the volatile Wall Street roller coaster.
Yeah.
So, Kaaren, tell me, how long have you been the president owner of uDirect IRA?
We're in our 8th year right now. I've been in the industry 10 years, but uDirect we're in our 8th year, coming up on our anniversary.
Wow. And in 8 years, how many people have you helped to get their money out of Wall Street into self-direction?
Just under 4,000.
Wow, that is a lot of lives that you have changed for the better, including me. I am a very happy client, customer of uDirect, and have had amazing customer experience working with you. But as a professional investor myself and an advisor to lots of different investors, I've recommended lots and lots of clients to invest with your company, and I've also experienced working with a lot of other self-directed IRA custodians, because there are a lot of custodians out there, and my favorite is uDirect. And but when people are looking at this video, there's going to be a lot of things that are very generic to all IRA custodians, and things that are also very specific to uDirect, because the vast majority of my clients are uDirect clients. So I do want this video to be helpful to the broadest audience and not to feel like a commercial. It's very instructive to get for people how to just shortcut, ask fewer questions, and find those answers here.
Right. Well, with self-directed IRAs, you're such a great customer too. It's not, there's also that, because you really understand self-directed IRAs, and so do your clients. By the time someone comes to us, they really understand what to expect, and I think that's what we're going to cover today. So before you self-direct an IRA, really know what to expect so that you have a good experience. Because if you think that we're going to be doing something that we don't do as a self-directed IRA provider, you'll be disappointed. So make sure you really understand the rules and the fees and how it all works, so that you have the right expectations and have a great experience.
I think one of the advantages and disadvantages of self-directed IRA is exactly the same thing, which is it's self-directed. So your company acts like a bucket where the money flows in either through contributions or through a rollover from an existing IRA, and then it just sits there and sits there until you as the client say, I have a great idea. I would like to invest my money in, and then it's your company's job to get that money to the place where the client wants it, as long as it's a permitted transaction.
It's kind of like escrow. If you're in an escrow state, you say, I want to buy a house. So you go to the escrow company and they start the transaction for you. They're administrative. They're not telling you what house to buy. They're not telling you how to write it off in your taxes. They're not giving you legal advice, really. They're just taking the money from where it is, moving it through the deal until you own that property. That's what escrow does. They're a neutral third party, and they're administrative. And that's like what we do. uDirect is a third-party administrator. We're administrative, not giving you tax and legal advice, not giving you investment advice, not recommending any particular investment. So that's one expectation to set up front about what we do and what we don't do. We're not going to ever tell you what to invest in. It's totally self-directed.
So there are certain transactions that I think are particularly awesome for self-directed IRA, certain investments that are definitely permitted by self-directed IRA, although I scratch my head and say, why would you choose that investment for a retirement account versus doing that same investment with just cash checking account funds? And then there's certain investments that are prohibited. So majority of people listening to this are probably interested already in mortgage investing, but I think it's important to talk about maybe the general rules of prohibited transactions and how they might specifically tie into what types of lending you could or could not do, because it would create a prohibited transaction.
Well, I mean, the prohibited transaction rules have to do with disallowed parties, so it's pretty easy to think about it. It's your lineal ascendants and descendants. So it's your parents and grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses, all disallowed to the IRA. So your IRA doesn't do business with these people. Your IRA doesn't buy assets from yourself. Your IRA doesn't buy or sell assets to any other disallowed person. That's one thing. Keep things arm's length with a self-directed IRA and you'll do okay. If your IRA owns a house, for example, outright, then you don't go in and swing the hammers or do the drywalling work, because that's called an over-contribution of sweat equity, and it's a prohibited transaction. So just remember, keep things arm's length with the self-directed IRA. Don't do business with disallowed parties.
A common question that I get is, hey, David, I'd like to buy a mortgage note, and then once I get my self-directed IRA set up, can't I just transfer it into my self-directed IRA? And the answer is...
No. No, we wish it was, but you can't buy an asset from yourself. So what you have to do is you have to make sure your IRA is open and funded, then shop for your deal, so that your IRA can take down this awesome deal when you find it. And you don't have to try to put it in your own name and then assign it to your IRA, because you can't do that. That's prohibited. That's buying an asset from yourself, and it's disallowed.
Yeah, another common question I get is, hey, David, I want to buy a house in my personal capacity and get a loan from my IRA to go buy it. My IRA will hold the mortgage, and then I'll own the house. How about that?
No, not so much. Not so much. Well, it's your IRA can borrow money. Okay, your IRA can get a loan, but it's not the Freddie, Fannie, FHA, VA kind of loan. It's not even a loan made to you, the person. It's a loan. It's a non-recourse loan. It's made to the IRA account. So you go find a non-recourse lender. They are going to evaluate the transaction based on the property's location and condition, but mostly on the cash flow of that deal. They want some cash flow going on. Sometimes they even require that you have a rental agreement in place before they'll even make the loan. So a non-recourse lender can make a loan to an IRA, but once they do, you run the risk, what's going to happen is that the IRA will probably have taxable income. So say your IRA borrows 30%, 70% comes from the IRA. Well, here comes a rent check. 70% goes right in the IRA. 30% came from borrowed money. So that 30%, that little piece of pie right there, is going to be taxable. And if you want to talk to your tax advisor about UDFI tax, unrelated debt financed income tax. So your IRA can borrow money, needs to be non-recourse, not a loan made to you. It's a loan made to the IRA account, and some of the income could be taxable. So you want to, we can talk more about it, but you need to know that up front.
Yeah, and so that kind of is a nice segue into there's certain things that you can do with your self-directed IRA, but as an investment strategist, I scratch my head and say, well, you could do that, but you really shouldn't. And one of the big rules that I coach my clients with is, let's say you decide to buy a house, and let's say you decide to buy a mortgage note, and that's an investment decision, right? And then if you put that house in your personal tax capacity, and you put that note in your IRA, that's a very tax efficient structure. But if you switch those two around and you put the house in your IRA and you put the mortgage note in your personal capacity, it's the same investment portfolio, but you've created a significantly adverse tax result by moving those assets in the wrong buckets.
I know what you're saying. Yeah, but at the same time, I just have to throw in this, that if you don't have enough money to buy the house personally, and your only option is to use an IRA to do it, that could still make a lot of sense. But you're right, if you have the choice, either personal money or IRA money, that's one scenario. Or if you just have IRA money and you're going to invest that, what should you invest in?
Yeah.
And you choose a house, that's a different scenario.
Yeah, there are definitely times where it does make sense for an investor to buy real estate in their IRA, but generally speaking, if there is a diverse portfolio that contains tax-efficient assets like real estate and tax-inefficient assets like mortgage notes, I really like to have my tax-inefficient assets inside a self-directed IRA. And then anything that's tax efficient, if I can own that outside of my IRA, I think that results in a better long-term result, for the immediate UDFI issue that you're talking about on financed property, but then also when you take distributions from your IRA, they're going to be distributed as ordinary income. Versus if you're going to hold the property and then take the capital gains on that sale outside of your IRA, usually the capital gains rates are going to be lower than your ordinary income. And then the other thing is when you have a death, right? You hold your IRA for your entire life and then you pass away. When you leave that IRA to your heirs are going to liquidate whatever assets are inside the IRA and distribute the money to you as ordinary income. Versus if you had that real property outside your IRA and then you die, it gets inherited with a step up in basis. The property is sold and there's no tax due. So very oftentimes when you're looking at long-term usage of self-directed IRA, which I love, it's a huge part of my investing strategy. I think everyone should have a self-directed IRA, but it's putting the assets into the right bucket to get the long-term tax consequence that you're looking for.
You know, people will do this. They'll buy houses in their IRA, but maybe they use a Roth IRA. And so when it comes out, what's nice about it is if someone passes away, they don't have to go through probate. The asset just passes from the IRA into inherited IRAs, so you don't have to go through all that rigmarole of probate. Then the beneficiary just receives an inherited IRA and their share of the assets. If it's a Roth IRA, it still comes out to them tax-free. But you're right, if it's a traditional or a SEP or a simple IRA, then they've got tax issues. You're right. So,
yeah.
You know, you're the advisor.
Well, I'm not a tax advisor. I am just a really smart investor who makes sure that I include tax as a significant part of how I'm doing it. And a important thing is not to let the tax consequence wag the investment dog, right? Don't let the tax tail wag the investment dog. Invest in the things that make sense, in the things that you understand, that are giving you the benefit that you're working with or want to create, and then you find a tax structure to fit the lowest legal tax obligation that you can come up with. And self-directed IRA is a significant part of that. Even when you're looking at traditional IRA and Roth IRA, you can have at uDirect 2 different IRA accounts. For example, I have had a SEP IRA at uDirect, I've had a solo 401k at uDirect, and a Roth. I've had 3 different kinds of accounts at uDirect, all at the same time. Because they allow me different contribution limits, they offer different results. And when I'm looking at the types of assets that I want in Roth versus in a traditional, they might be different. For example, I want if I'm going to hit a home run of a deal, I want that in my Roth because when it comes out, it's going to come out tax-free. If I'm going to go in my overall blended portfolio of risk, if I want a relatively conservative investment, I'm going to put that in my SEP IRA because, it's a place where I'm going to have small gradual gains, and then when it comes out, it's going to be ordinary income, but it's the place that I'm investing for security rather than the Roth money. I want to hit it big, because it's so hard to get money into Roth. You're usually putting small dollars into Roth, and so you want those small dollars to do big things.
Now, I think you would be doing the backdoor Roth, am I right? Where you contribute to a SEP, where you can make a large contribution, because you probably make too much money to contribute to a Roth now. So what you can do is the backdoor Roth, contribute to your SEP, which in 2017, the SEP contribution limit is now $54,000. So that's the max contribution. So you put $54,000 in the SEP, and then convert it to Roth, and then now you've got, of course it's a taxable event to convert, but then, then you can invest 54 grand outside, and they still allow the backdoor Roth. I mean, Congress created it in 2010 when they had the TIPRA rule, act or whatever, Tax Increase Prevention and Reconciliation Act created this backdoor Roth in 2010. Well, it still exists, so you can still contribute to a SEP and convert to a Roth, even though you can't contribute to a Roth straight up.
Yeah, I love that you even have a name for it. It's the backdoor Roth, because that is a very viable strategy for high income earners. Is you're contributing very candidly. I put money in my SEP for one day, made the contribution to my SEP, and then the very next day do a rollover from my uDirect SEP IRA to my uDirect Roth IRA, and then I can make the investments directly from my Roth.
Yeah, how smart. And you can do it. You're allowed to do it still. But Congress talks about closing the backdoor Roth, that they opened in 2010. So we'll see. But for now, it's still allowed.
Yeah, and there's a mistake that I made in my own use of that backdoor Roth, is I did make an investment in my SEP, and it earned income, and then I sold the investment, and then I converted to the Roth. And so what happened is when you grow your SEP IRA, then that grew tax-free or tax-deferred. That's nice. But when I did the rollover, now suddenly I had to pay tax on the larger amount. Versus if I had done the rollover and then invested, that would have been lower tax consequence. And so my mistakes are the benefit of all of the viewers out there. To use that backdoor Roth, I think is very, very powerful. And for people who are really wondering why you would do it that way, is you can contribute more money to your Roth that way, and people who are not eligible for Roth contributions because their income are too high can now make contributions because of that backdoor strategy. Yeah. So once someone has their decision that they want to create a self-directed IRA, a lot of people say, well, David, I've got some money at Fidelity or Schwab, and I want to buy a mortgage note with it. And I have to say, no, you can't use your Schwab and Fidelity money to directly invest in the mortgage note. You have to set up an account with uDirect. And then how does that work from there, Kaaren, where somebody now has an account with uDirect and they've got their cash over at Fidelity and they want to buy a mortgage note from my company? What happens behind the scenes until they can get that mortgage note in their IRA?
Sure. Well, the whole process, say the money's at Fidelity, the way they get it to us is they open an account. That's the first step, open an account. The second step is to fund that account. So they fill out a transfer request form. They fill it out, they sign it, they give it to us. We sign it, we send it to Fidelity. So what we send to Fidelity is a signed transfer agreement where the account holder signed it and we signed it, all right? Fidelity gets it, they say, okay, this is great. They take about 2 weeks and then they move the money over and it lands in the account. Now, if it's a wire, it's available the next day. Checks have a 10-day hold. You really want to plan for that if you're in a hurry. The reason for the 10-day hold is there's this clawback period, right? A 10-day clawback period where people can come back and take their money. So we've gotten hit on 1 or 2 of those. So that's pretty expensive. You invested in a deal and someone claws back their 50 grand. That's, then you got to cover that. So we have a 10-day hold on checks. So just wire the money if you're in a hurry. So that's what happens. You open the account, you fund it, and now the money's sitting there. But then while we're waiting for the money to arrive into your account, you give us a note, say in this case, and you give us our direction of investment. So the supporting documentation will be the note, or if you're buying a house, it's a purchase contract, or it's the contract, whatever asset you're buying, together with the direction of investment form. Then our transaction coordinators will review it, help you tweak it so it's all perfect, and then we're going to send it for compliance review. So we're going to have 2 layers of review. We're going to have a compliance review, and just before we push that button and fund it, we're going to have a funding review. One more look at it before we, make sure it's all okay before we send the money out. So 2 reviews, and then the money goes out. Then now your IRA has invested. All the proceeds must come back in the IRA that owns the asset, and all expenses. If it's a note, maybe you've got some collection or you've got a loan servicing company or something, all those expenses are going to be paid for by that IRA that owns the asset. So as long as you just remember, expenses and income go back and forth from the IRA, you're okay. The minute you take those proceeds and put them in your own pocket is when you've taken constructive use of your IRA. That's bad news bears. That is just, game over. And now you get your IRA back as a it's no longer an IRA. You pierced that little veil there.
Yeah.
So you want to make sure to do it right.
So for the sake of redundancy, the client sets up the account with you, then they sign a document. Your company sends the document to Fidelity, or the current holder of the cash. Then Fidelity liquidates that position to cash. Then they wire. I'm going to underscore wire because that's way better to send a wire.
And our wire fee is super low. It's only $15.
Yeah, and on a digression, here's the deal. It's $50 to have a wire. 15. Wow, that's ridiculously cheap. And so if you're moving $100,000 and your earning capacity on that money is, I don't know, $20 a day or better, right? Then if you get that money 10 days sooner, you're talking about $200 of earnings on a $15 expense. And I've had so many clients that they send that, I don't want to pay the wire fee, let me just have a paper check sent. And then they're waiting on a week to get their money invested, and they've lost, a couple $100. Sometimes they lose a deal over it because they just can't get their money invested soon enough.
That's true.
So anyway, don't be short-sighted. Pay the fee. Get that money working sooner rather than later. But I digress. So then the wire is sent from the original Wall Street seller of mutual funds to uDirect. uDirect then receives the direction of investment letter from the client that says, here, uDirect, this is what I want you to do with the money. uDirect does that thing with the money, and then they're fully invested. Is that pretty much the process?
That's exactly it. You got it. Yeah. Open, fund, invest, but you said it really nicely.
Nice, nice. So in the case of mortgage notes, a really good best practice is once the money leaves uDirect, it doesn't usually go to the seller of the note. It will usually go to the title company holding the transaction. Or in the case of purchasing real estate, it goes to the title company holding escrow. So it is a little bit of a, like, the money is moving around, right? From Fidelity to uDirect to Chicago Title Company to then the actual seller of the asset. And one of the nice things about working with a title company is a lot of those transactional expenses happen at the title company level, and they all get combined into one transaction, so that when they fill out a direction of investment request, they say, hey, uDirect, send one transaction to Chicago Title Company. And then at the Chicago Title Company level, or whatever title company you're working with, there might be a dozen expenses or a dozen different debits and credits, where if they were trying to do them all through their account, there would be a transaction fee, a $10 fee for every single one of those movements of money in and out. Is that correct?
Yeah, on the HUD-1, sure.
Yeah, and the same with property management. Like if you are buying a piece of real estate, generally I encourage my clients to have as many debits and credits as possible at the property manager level, not at the IRA level. And with the mortgage note, definitely have your mortgage notes professionally serviced. And not only is that a good best practice to help the investor, but for IRA compliance of not making an excess contribution. Kaaren, tell me, like, why can't an investor do their own mortgage servicing and debt collection of an IRA-owned note?
Well, they can to a degree. So let's be clear about this. So and you can service the note if you want to, like, have an amortization schedule. You can, obviously select your borrowers, because you need to do that anyway. You can have an amortization schedule. You can go pick up and collect that check, that payment, and send it to the IRA yourself. So you can service it in that regard. But when it comes to active participation in the note, for example, a foreclosure proceeding or something like that, you can't service that. You have to be careful of what you actually do. So you can service it to a point, but a lot of times notes are passive investments. You want a servicer so you can go about your life. The small amount you pay a note servicer is worth it, so that you're not spending your whole time with your nose in a book being an accountant and working on that transaction. So you can do a little bit, by collecting the money and sending it to the IRA, but that's about it. You could just keep your own QuickBooks log of what's happening. We have a screen you can log into and see the activities, so you see what's happening.
Mm-hmm.
But as far as servicing the note, what if it's like a mortgage note, and there's property tax, there's hazard insurance? That's when you want a loan servicer to make sure it's all happening correctly.
Yeah, so my business practice is, if it's a business-to-business loan, then I like to do that servicing in-house. If it's a business-to-consumer loan where the borrower is living in the property as an owner-occupant and there's the impound of taxes and insurance, I don't want to touch that with a 10-foot pole. There's just so much regulatory compliance around that. I love participating in those loans as an investor, but as a servicer, you definitely want to get some professional help, whether it's an IRA-owned asset or not. That servicing is really distinctly different if it's consumer, borrower, or investor.
Well, with self-directed IRAs, you're pretty much going to be working with investment property, and you're going to have renters. But if your IRA could make a loan to someone that they could use as a mortgage loan for a primary home. But yeah, you're right. The rules are so different. You really want to know what you're getting into law-wise, because how you can go after somebody who's living in a primary residence. And yeah, you're right. The laws are just all different. But self-directed IRAs are always for investment purposes only. So you're buying an investment property.
Mm-hmm.
And
Yeah. So now that my IRA owns a mortgage note because the money went from my original IRA to you as a custodian to the title company and then to the seller of that note, and now that note vesting doesn't have my personal name on it. It doesn't say David Campbell. How should I take title to that particular asset?
Well, it's like this long. It's the custodian for the benefit of your IRA. And if you have a long name, then you're really toast, right? So what you might want to do is get your borrower or a rubber stamp so you could just stamp it. And then that way they can stamp their checks every month and make it out. But it's going to be the name of the custodian for the benefit of, we abbreviate it by saying FBO, for the benefit of David Campbell's IRA. So yeah, you want to get a rubber stamp for your borrowers so that they can write their checks.
Yeah. So for example, my account is American Estate in Trust LC, FBO, David Campbell IRA, or SEP IRA, or Roth IRA at the end.
That's a lot of like little, letters and stuff.
Yeah, and if my borrower, being lazy, just writes David Campbell on that check, your company doesn't want to deposit that.
No.
And if I deposit that into my personal checking account,
No. Yeah.
problematic, right? Both.
Yes, then you've taken constructive use of your funds and your IRA is no longer an IRA. Now you've had constructive use, so now your entire IRA can get dispersed to you as a taxable event. You never, 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 ever, ever put IRA money in your personal account. And you don't pay any expenses out of your own checking account. That would be very bad.
Yeah. So now I've got to train my borrower to make that check payable to American Estate and Trust LC FBO David Campbell IRA, or they make it to August REI Loan Servicing, right? And then they're paying the loan servicer, and it would much better, right? Because now they're paying the servicing company. They don't even really know who their lender is. They think oftentimes that the servicing company is their lender, and the borrower sends the questions to the servicer. They make their payment to the servicer. Now the servicing company receives the money, and now they send it to me personally in my personal checking account at home, right, Kaaren?
Yeah.
No, they send it to uDirect, right?
They send it to us. Yeah. They put it in your IRA. Absolutely. Yeah.
Yeah.
And there you go. Then now you're building your net worth. And when you retire, you're going to be so happy with yourself that you did this because you've got a real nest egg to live on when you're not working anymore. And this is it. I just got to this point. Most Americans are not prepared for retirement. I mean, you need like more than 3 million to live off. You've got this capital, and you want to live off the growth of your capital. Just take the grain or take the seed out. So the point is that you really need to save for retirement. It's a huge deal, and self-directed IRAs help you do that. Our average account size is about $100,000. So if you have $100,000, I mean, that's great. That's awesome. But if we did this math. So if you're 59 and a half, and you're going to live till you're 86 and a half, so you say, well, I'm going to take an even distribution every month between now and 86 and a half, and assuming no gain or loss, you're going to have $400 a month to live on. That you haven't saved enough. So we've got to save for retirement. Even today after you watch this event, just go write a check to yourself, write a check to your IRA, save your money, put it aside. Maybe you get a tax break. Tell your tax advisor, save the money that you're allowed to, because sometimes when you make a contribution to your IRA, it means it reduces your tax. You've just paid yourself instead of the IRS, which is great. We all have to have more than we have for retirement, unless you're Bill Gates or somebody else, or Zuckerberg or something. You're not going to be able to afford to retire. So it's just incredibly important to use these tools and to take advantage of being able to contribute to an IRA or a retirement account of some kind.
Yeah, and one of the biggest advantages, I mean, it should be obvious, but it oftentimes isn't. You put the money in, and ideally you get a tax deduction for the contribution, so you're contributing pre-tax money, or in the case of Roth, you're contributing post-tax money. But then you get to earn, and then the earnings get reinvested before you pay the tax. And that is the magic secret sauce, is the compound interest on your money, or the compound earnings. And one way I like to look at it is you're getting an interest-free loan from the IRS for your entire investing career. Until you start taking that money out, you got an interest-free loan on the taxes that were going to be due on that money. So who doesn't want to borrow money from the IRS at 0%?
Well, and then to add to your point, you're compounding faster. So here's what happens is like you invest your IRA money in X, then here comes back X your capital plus the proceeds. Now it's not diminished by tax. So you get to take that whole new amount, that larger amount, send it back under the next deal, earn more money, it comes back. So you're compounding that whole time. I think that's kind of what you're saying. But you're really compounding your savings in that regard because they're not diminished by tax. That's the goal until you actually retire. So yeah, it's a great vehicle. We really all need to be using this. You have to be smart because you got to play the game to win, right?
Yeah. So one reason I really like mortgage notes, particularly for IRA, 100% of my IRA is invested in mortgage notes. And I own lots of property. I love owning real estate. I own active businesses. I own lots of different commodities and things, etc. But I use my self-directed IRA exclusively for mortgage investments. And a couple reasons why. One, mortgage investments or mortgage note fractions, where you take a $100,000 note and you can break it up into pieces. And maybe for even as small as $20,000, you could own 20% of a $100,000 mortgage note. It allows me to invest the money that I have, right? So let's say I have $30,000 in my IRA account. Maybe I could go put $25,000 down on a piece of real estate and finance the balance, but then I've got $5,000 hanging out in my self-directed IRA doing nothing, and that $5,000 that's uninvested is a drag on yield, meaning you got to count it in your total capital stack even though it's not invested, right? Versus if I'm buying mortgage notes, then I can, if I've got $30,000, well, I can invest $30,000. In fact, if I have $31,512.02, I can invest that exact dollar amount in a mortgage note fraction so that I can sweep my account. And that is my goal, is every single month when I get a deposit from the note servicing company, I look at what my cash balance is and I say, let me go find a mortgage note fraction that I can invest 100% of my account balance, except for the minimum required deposit that the custodian requires. And that's an interesting point because a lot of clients make this mistake. They look at their uDirect statement, and this is common across all custodians, but they look at their custodian statement and it says cash balance is X. And then they look at cash available for investing and it's smaller, it's not X. And so they say, David, I'd like to invest in this mortgage note and I have cash balance. That's how much I have to invest. We write all the paperwork, we submit the forms to uDirect, and then you say, wait, they don't actually have that. They have the cash available for investing, which is a smaller amount. Tell me.
$325 less, because that's the minimum you need to leave in your account. You're right. So that's very common. So that's why our transaction coordinators, when you give us the note, they're going to compare that against the actual amount that you have to invest to try to save that from happening so that you don't come into a train wreck right at funding. That we try to find that up front. That's all.
Yeah, the other part that some people get, because my goal is to reinvest my capital every single month. I don't want to keep a balance in my custodian account. I want to get reinvested so I can get compound interest. I want interest on my interest as quick as I can. There's a very small hold period. So when the note servicer takes my interest in principal and deposits it into my uDirect account, that's going to show in my cash balance, but then when I look at my cash available for investing, it's not there yet because, like any bank, where there's a hold on deposits. How does that work? What's the hold period for deposits?
Sure, we were talking about that earlier. So a wire, if it comes in wired, it has to go through the Federal Reserve and it hits our bank, and then we have to take it from the bank and then download it into your account. So there's a 24-hour, so you wire it today, 24 hours later, it's going to post to your account. That's pretty straightforward. So that's a wire. Checks do have a 10-day mandatory 10-day hold, as I was explaining, because there's a clawback period where somebody can say, uh-oh, no, and they can come claw it back after maybe you've reinvested that money and now it's gone out of your account into some new deal, but they come and claw it back, and then we're left holding the bag. So there's a 10-day hold on those funds if they arrive by check. So just plan for that. It's simple.
Yeah, and so it's not just the original IRA contribution that people should watch out for, but it's any like rental deposits or mortgage interest deposits, any check. Because if the check bounces, you don't want to be left. uDirect isn't going to be left holding the bag on that. It's got to
Well,
clear.
sometimes it looks like it clears, and then that's what I'm saying. Then it can be disputed at that time after it's actually cleared. So there's a certain period of time for when that clawback period ends, when that risk ends of having that money taken back after you've already reinvested it. So
Yeah.
10 days is okay.
So when I'm a mortgage investor, I like to log into my investor portal at uDirect, and it's a really awesome tool. So I log in, and I can see that cash available and cash balance, and I'm smart enough to look at both, right? Because I'm looking at, hey, my funds aren't yet available, but they will be, so I'm forward planning what notes I'm going to buy when those checks do become available. And I'm also looking at to see my list of assets, right? And so I'm seeing, did the note that I buy, is it properly listed on my uDirect account as a list of assets? And then when the income comes from the note servicer over to uDirect, I want to see that that was properly posted to my account.
Wow, and you're making such a great point because it's self-directed. So you must check your account because sometimes the note servicer will send the money and not tell us what note it's for. Maybe you've got a loan servicer and they're servicing 3 of your loans and they send money, but they don't happen to include what loan it's for. We're still going to put it in your account, but we may not know to attribute it to a certain asset if the loan servicer didn't tell us. So that's why as a self-directed IRA owner, you definitely need to log in and manage your account, manage and make sure, hey, the money came in, but was it credited to the correct asset, yes or no? And again, if it isn't, it's typically because the servicer didn't write the asset ID number on the check. We don't know what asset it goes to.
Yeah. So one tip or trick that I like to work with my note servicing companies is the note servicer. Let's say I had 10 mortgage notes and they receive a payment for each note, and then they send every single one of those as a separate check to my uDirect account. After I've used up my series of free transactions with uDirect.
12 per year, yes.
Awesome. And then I'm paying $10 per deposit, and I got 10 notes, and I'm paying $10 each. That's $100 a month. I'm paying $1,200 a year. Right? But the trick is, right, I have my servicing company. They collect the 12 deposits. They batch them into one, and then they send it over the fence to uDirect, and it's one a month. You get 12 free a year, and if that's all you're doing, then you're free. You don't ever pay that $10 fee.
You just paid for your loan servicer, like your own loan servicer just paid for themselves right there.
They did, yeah. The other thing is if you've got a small account balance, a really small account balance, and so the amount of money that you're getting into your servicer account isn't enough to reinvest on a monthly basis, then I'll have my servicer make that deposit to my IRA quarterly. And so the servicer is batching up loan payments, and after 3 months, they send one check over the fence to uDirect, and that's just fewer transactions at the custodian level, which makes your services even more affordable.
It really does. And and our fees are the lowest in the industry. Most people charge
They are.
more, or they charge you a flat fee plus a bonus fee, or they charge you a sliding scale based on the value of your accounts. We don't do that. It's a flat fee, regardless of the number of assets, regardless of their value. And it's such a value in that regard. So if you have to pay some little ancillary $10 fees, they're minimal compared to what you'd pay anywhere else. Just got to throw that in.
It's true. First of all, I think uDirect has the best service in the industry, and I have nothing to gain by saying that. I don't have a vested interest in uDirect. I'm just a happy customer, and I've worked with every major IRA custodian in the industry in my capacity of helping investors. And uDirect, it does have the best customer service. And then in terms of fee structure, I've only seen one other custodian that was like $5 cheaper, right? And that custodian, their service wasn't as good. And secondly, they take for forever to fund, right? And they've got this book of paperwork. Every time you want to make an investment, here's 50 pages, fill this out. And I think there's a lot of custodians that deliberately make it difficult to get the money out of your account because the custodian wants to hold on to the uninvested funds. And uDirect is exactly the opposite, in my experience. It's a one-page direction of investment, and it's ridiculously easy to fill out. And it is very easy, and the turn time is very, very fast. I've worked with custodians where I send the paperwork to uDirect, and 2 to 3 business days, done. Funded through compliance, the wires at the title company. And I've worked with other custodians where we did the exact same process. We filled out their 20-page document. It sat in compliance for 2 weeks, and then nothing happens. And then you call the custodian, like, well, where is it? Oh, well, that person is not working right now, and press 2 for bad customer service. And then like a whole month goes by, and then they fund the transaction. A month, that's a new record. From the time you submit the DOI till funded, the worst was 30 days. But I would say standard in the industry is probably about 7 to 10 days. And where uDirect is 2 to 3 days, I'm experiencing from other custodians 7 to 10. And so if you're a mortgage investor and you're looking at every time I invest, I can get my money working 5 days faster if I choose uDirect, it's 5 days of interest. And so if you've got a large account, then that extra 5 days of interest every time you make an investment is huge. That is the most expensive part of custodians, is when they drag their feet in funding. And I think that it's your money, and it's uDirect, and it's your money, and you should be able to get it out there as fast as possible. And I just give a high five to the people at uDirect, because you make that happen. You make it easy to get your money
Of course, you
where it
just
needs to
made
be.
my whole day. Thank you. That's awesome, to hear that, and thank you for sharing it. You're right. You've got to invest in order to build your retirement. We want you to retire with some money, behind you, so you've got some savings, so that we want to provide that opportunity and that tool for you to use, so that you have a way to save for retirement in a way that you have some control over. Because you might not feel like you have a lot of control over the stock market, which we really don't. And we also don't have control over the fees they take on the back end. I mean, the Department of Labor came out with new rules. I know that, about what can be charged. But there's so many hidden fees investing in the stock market. But when it's a self-directed IRA investment, 100% of that money that you've just earned comes back in your IRA, and you keep 100% of it, less your fees that are already predetermined and disclosed to you up front.
Yeah, I was talking with a client today, and I said, you should really roll your money from your Fidelity IRA to a self-directed IRA at uDirect. Number one, you're going to get off the roller coaster. You're going to get significantly superior returns as a mortgage investor with significantly less risk. And who doesn't want better yield with lower risk? And they said, oh, but I don't want to pay $300 or $275 a year. I'm like, do you know how much you're paying your Fidelity broker, who is churning your account, and they're sucking the yield out of your account because the only thing that they can sell are Fidelity products? They can't sell you a mortgage note because there's no way for them to make a profit off of selling you mortgage notes.
A great expose on that is the guy John Oliver on HBO, and if you look up John Oliver and 401ks, he just really put it out there. It's a phenomenal little expose, and then he throws in some teacup pigs to make it interesting.
Yeah,
but he really nails that point to the ground. It's awesome.
Yeah, and people ask me at least once a week. Someone will say, "David, it sounds so good. How come everyone doesn't do it?" And I say, I don't know. I don't know. Well, because
we don't know. We're like the best kept secret. I was just explaining to somebody today, because we've got the Super Bowl coming up, right? So when you watch a Super Bowl, how many ads are done by brokerage houses? I think if all of the self-directed IRA companies combined took their net profit for the year, we probably couldn't afford one Super Bowl ad. I mean, that's probably close to being true. So just to say it's super expensive, how could we possibly afford a Super Bowl ad if you're earning all the capital from your investments, if you're earning all the return from your investments, is what I mean to say. So if they can afford to pay for the Super Bowl ads, whose money are they spending? where does that money come from?
Yeah.
We're not putting a Shankopotamus commercial on the Super Bowl. So
Yeah.
just think about it. Who's paying for that commercial?
Yeah, when you're working with mutual fund salespeople, some people call them financial planners, but they're really, most of them are mutual fund salespeople. They can only sell you homogenized investments that are duplicatable, meaning they go to their catalog and they say, well, I can sell you any one of these, and there's an infinite amount of these available. So whether you're investing $5 or $500 million, I can sell you any of these. They're all available, right? When you're doing self-direction in things like mortgage notes and real estate, they're not homogenized. They're
No.
because every note is different from another. Every house is different from another. You can't just call your broker and say, "Give me a house and give me a mortgage note," because which house, right? They're very different.
It could be in beautiful Oregon where you are with beautiful trees, or it could be in Florida, or it could be in Wisconsin. It could be anywhere you like.
Yeah, and so because it takes some brain power to do the analysis and to make decisions with your account, most people aren't trained or equipped or interested enough in taking control of their investment decisions. So it's easier just to say, I'm going to let some guy who's churning my account to make fees make those decisions for me, and they get mediocre results, and they say, how come my account goes up and down every single day? Well, nobody knows. Nobody
I
knows.
don't want to bother with it. Just you do it. I don't want to. Don't I even want to know about it. You invest it for me. I mean, wow.
Yeah.
We say things that we don't mean sometimes in that regard. So self-direction gives you all that freedom and all that responsibility. Like Spider-Man, the movie Spider-Man, with great power comes great responsibility. Well, that's true with this IRA, right? When you're investing it, you really need to do your due diligence. And I got to say, because your IRA invests in an asset, well, what if that asset fails?
Yeah.
What if it doesn't succeed? What if you don't make a profit? And then what are you going to do about the loss? Well, in an IRA, you don't get to write off that loss. And if it's totally a wash, you can't just pick up the phone and say, hey, you direct that account, that asset that I just invested in, that went nowhere. So just, zero out my account, just close it up and just, wrap it all up for me. Thank you, goodbye. No, it doesn't work like that. We can't just write down a zero value without proof. So if your IRA invests in an asset that goes to zero value, it's like adding insult to injury. And you need to know this up front. Your asset goes to zero. You also have to pay a valuator to prove it went to zero. Okay? So that's $600 roughly for a valuator to write a valuation report saying it's truly a worthless asset. We can't determine the value of an asset. We're not fiduciaries. We don't say what an asset is worth. It's self-directed, and it's up to the account holder to provide that value to us. So, you want to make sure that you do your due diligence and you make a great investment. You also need to know what happens on the back end if you're unsuccessful. Now, that just happens to a teeny fraction of our account holders, but if it should, you need to know that, right?
Awesome. Hey, Kaaren, as we're finishing up today, how can folks who are listening to this video get a hold of you and your company, and the best way to engage with you? And is there any other follow-up resources that you want people to know about?
Absolutely. I mean, we're all over social media. You can find uDirect IRA on Facebook. You can find us on LinkedIn. We have a group called Self-Directed Investors /Networkers. We've got about nearly 3,000 people in that group that talk about their deals. We're on LinkedIn, like I said, we're on Instagram. We've got all the social media. Our website is the letter U, uDirectIRA.com. So much information about self-directed investing. Maybe links to the IRS and the website, IRS's website about how these things work, like Publication 590 that teaches you all the rules of IRAs. That's what a self-directed IRA is an IRA. And so we've got so many resources on our website. You can email us at info@uDirectIRA.com. And on our website, we have a free report. So you can just click right there, and it's right in the upper right-hand part of your screen. Click the free report, put in your email address, and up comes a PDF of our free report. And so read that and learn more about self-directed IRA investing. Call us. Our toll-free number, 866-538-3539. All these different ways to reach out to us that we want to communicate with you and share with you what it is to self-direct and share with other people and their experiences.
Yeah, and it's really important when you build your team because you do need a team. Like Kaaren is the bucket. They hold the asset, but you need assets to put in there, right? And so that's where I fit on your team is helping investors find assets that make sense for their self-directed IRA, be it turnkey real estate or it's different parts of the market cycle. We've done real estate syndication, and my current favorite investment du jour is hard money lending, using your IRA to be a hard money lender to buy existing mortgage notes and to get interest income and mortgage note fractions as small as $20,000 invested into the mortgage industry at 9-10% interest rate.
And it's so worth your while to take some time as an investor to learn more about what you're talking about. If somebody hears what you're saying, David, and they think, what does that mean? What does fractional note mean? I mean, gosh, learn, because what you're saying, David, here is that this is a great way to churn your money and to keep, gaining your wealth, so that you can have a comfortable life and take your family to Disneyland or whatever you want to do, just have the life that you want. And it's just so important. You can Google this information. You can talk to David. You can go to real estate investor clubs. You can, online, there's so much information, but you really have to learn. And I think that's what you like to be. David is a resource of information. We like to provide as much information as we can too and teach and help people learn how to become wealthy and how to save for their retirement. That's the bottom line.
Awesome. Thank you everyone for tuning in today. Hope you check out my website at hassle-free-cashflowinvesting.com and also head over to the letter uDirectIRA.com. And if you've got any questions, we'd love to hear from you.